if they got at least 20% and they've got seasoned funds and they understand that they not have to pay PMI, then that might be not a good candidate for FHA. But somebody has got 20, 30,000 and they have to tap out their retirement account and they're basically squeezing and have no money in the bank after they close. FHA may be the better option. That way they can have more money in their account, they get a gift from a family member and be able to get into the home more comfortably. But a lot of these, a couple of key points with FHA is that you have mandatory impounds. There's no option. You must have taxes and insurance
with FHA.
With FHA, must have it. There's even with 50% down FHA, you still need impounds. So there's that's never going to change.
And MI.
And mortgage insurance. And I want to go over mortgage insurance with you too. There's two types of mortgage insurances, and it's a very common question, and I had that conversation 3 times just with my 3 clients last night. You always got to remember there's 2 insurances that need to be applied towards FHA loans. It's the mortgage insurance premium, and it's 1 3/4%. It goes directly to HUD. It's financed into the loan. A couple key points here is that within the first 3 years of the loan, let's say they convert it into a conventional loan, they can get a portion of that mortgage insurance premium refunded back to them from the federal government. So let's say, for example, first 3 years, they refinance, or they pay down the mortgage, or they want to refinance into a conventional loan. 2/3 of that 1 3/4% will be a check sent directly to the borrower.
I'm sorry, you said within 3 years? Or?
Yes, within the first 3 years. After the 3-year period, it is no longer refundable. So there is motivation and incentive to try to get into a conventional loan within the first 3 years. It's a prorated refund. So after 12 months, they refinance into a conventional loan. They'll get 2/3 of that $12,000 back, or $8,000. But it's not money out of their pocket. It's just money that's financed into the loan. And it goes directly to HUD. The broker, the lenders don't get a piece of that. There's also a monthly mortgage insurance premium. The main factor is 0.55. It's still cheaper than conventional. If you put a little bit more money down, it goes down to 0.5. If you put down 10% or more, it goes down to 0.5 as a factor. Even with 15% down conventional, the factor is, I think, 0.62.
What was the percentage?
0.55 is the MI factor. So you multiply the base loan amount before the MIP by 0.0055. Divide that by 12, and that's your monthly mortgage insurance payment. Now, the reason why I put down 5.01%.
Can we quick comment about that? When we advertise, when we talk about the FHA rates, when you see them on the rate sheet, when we talk about those, that's the base rate. That does not include the mortgage insurance. Add about a 0.5 point to that to get the borrower's effective rate. So if you're at 5.5 base rate, you're going to be roughly at 6% when the borrower gets qualified with the mortgage insurance. And that's regardless of 3% down or 30% down. It's always there. Okay.
Yeah, the APR will be reflective with the mortgage insurance premium. So you'll see the APR, the rate plus the MIP is, plus then the closing costs will be the APR. We're going to be really spending a lot of time trying to be extremely accurate with our APRs with the new lending laws.
So let me just, so on a $500,000 loan, you're talking a mortgage insurance of $1.25 plus 0.55.
1.75.
0.75.
1.75.
Yes.
Okay, $1.75 plus 0.55. So it's roughly 2.3% of the loan amount.
They're separate.
2 separate payments. One is the 1 3/4% funding fee.
That's just upfront, financed in.
Right.
Goes to HUD. Goes to HUD.
Goes directly to HUD. And there's also a monthly mortgage insurance premium.
That's the PMI.
That's basically the PMI.
Where does that go?
Goes also to HUD as well. That's the money that they're going to be using for anticipated foreclosures down the road to fund that next potential crisis.
It takes a lot. I found out in banking, it takes a lot of little bitty percentages to pay for one foreclosure.
Right.
It's a losing game trying to make up for
Oh,
potential loan losses.
And that's why the
with
government's
interest
investing
rates.
in it.
That's why the
Because it's
government
a losing
invests in
game.
it. Well, it's a stimulus, you could say.
Sure. Well, I wanted to talk about a little bit about down payment. The reason why I have 3.5 to 5.01% is because when you have the jumbo loans, of any loan amount above 417, and the borrower still wants to put the minimum down, you can avoid the 2 appraisal requirement by putting down 5.01%. So that 1.5% extra down payment may save them an extra appraisal, and it's nice. Sometimes it's a good option. Now you also have 3 and 5 year fixed options as well with FHA. We can talk about that too. As rates have kind of risen in the last week or so, I've noticed that the 3 and 5 year option makes a lot of sense. It's a much more stable 5 year and 3 year fixed in a conventional. There's only a 1% annual adjustment after the fixed period is up. There's only a 2% margin, and the life cap is 5% from the start rate. So it's a much more of a stable, and it's based on the 1 year treasury, one year T-bill. If it adjusted today, it would actually go down to 3.2%. And I'm noticing 3 and 5 year fixed are in the low 4s. So that might be still an option as well.
So you're saying it's a 3-year fix?
There's a 3 year fixed and a
And a
5 year fixed available for FHA. We can go over, I can spend an hour just on that, but just wanted to touch base on you on that. I've noticed a lot of success with that.
And it's about a 0.5 to 3/4% lower rate than on the
Then a 30 year fixed.
30 year. Wow.
And you qualify at the start rate on
Okay.
if you put down 5.01%.
Okay.
Sometimes that could really save a transaction. And because I like this intermediate fixed, because it's a much more stable index, or much more stable adjustable than the conventional loans. There's a 2% annual cap on the regular conventional loans, and the life caps are 11.95, so it's much more stable.
Are there other benefits to putting more money down? More than 5%?
Well, yes, in a touchy situation, put down 10%, that's considered extremely large down payment in FHA world. And so if you have like a high ratio issue, or you have a FICO score of 645, or they've been at their job a year and 3
What if
months,
you're a realtor and can't get a loan? You want to put 20% down?
yeah, it's all about documenting income.
Yeah, and you document, because now, I mean,
You can get a non-occupant co-borrower to help
can
out.
you get rid of the PMI if you put 20% down?
No, it's always going to be there.
PMI is always there, and there's no other benefit to putting more money down.
Well, let me rephrase. If you put down 20%, the minimum mortgage insurance that you have to pay is 12 months. So you put down 20%, pay your 12 months. I just did this for a client. If you have the balance down to 78% of the original value, then that PMI will go away.
PMI goes away at 12% down?
With no, it must be at 78% of the original.
22%.
Let's go to
22%.
22%.
I'm sorry, okay.
And then, but they must make minimum of 12 months of payments.
After 12 months.
After 12 months, and then they can go back to HUD and try to get that removed.
But if you could put 20% down, why are you going after
Exactly.
FHA loan? in
Well, the
first
reason
place?
why, because this one borrower that I had no money for the down, it was all gift. And conventional B of A just
right.
couldn't do it.
Right.
Well, and also
So-
your debt ratio is a lot higher.
Right.
Right.
So
They just
that
couldn't do it because it was all gift, and then you also needed 6 months reserves. FHA, no problem, we were able to do it in 10 days, to be able to just convert it over.
So are we seeing, is the gift aspect becoming a real problem in lending, even in non-FHA loans?
No, let me answer that question. The gift is not a problem, but conventional lenders, even if you're doing a gift, they're just going to require the borrower to put at least 5% of their own funds into the transaction. Okay, so you can get a gift for 30% of the transaction, but they still want to see that the borrower's got 5% of his own money invested in it. So if you have a situation like this where you have an FHA deal where the borrower doesn't have any of his funds, if they're all coming from gift, if they're all coming from a gift, FHA may be the better way to do it because they don't have those same requirements of down payment. The other question that you had about if you have 20% down, why would you go FHA? Well, look at the difference in the credit scores. You have
Yeah.
somebody that's had, credit score of 620 as opposed, FHA has become, in a way, since there's no subprime left anymore, it's probably the kind of the intermediate step between prime and subprime.